Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Tesla, the stock is down 6% here today. They missed pretty significantly on their deliverables for the first quarter. Again, stock down 6% today, off 33, about 34% year to date. So definitely a challenging time for the folks at Tesla. Steve Mann joins us, global autos and industrials analyst for Bloomberg Intelligence. Steve, put into context this miss here. How big of a miss was it, and what does it mean going forward, do you think, for Tesla?
Oh, it's definitely a bad day for Tesla, as you can see the stock. Look, it's a bad time. They just actually raise prices on their cars, puts into question about that strategy. Their inventory jumped by 46,000 units. It's at the all-time high at the moment. So there's a lot of questions out there, with the end market, the consumer hesitating a bit on buying EVs. So what's going to be for Tesla going forward? Definitely their 1.8 million sales target for the year is definitely at risk.
Do we know why? What's the why behind it? They're going to talk about production misses in terms of supply chain issues, etc. But then Rivian kind of crushed it. So what's the real reason here? Yeah,
they actually, Tesla attributed to the Red Sea hostilities. Mm-hmm. And that's partly right, because a lot of their Model 3 and Model Y, the best-selling vehicles actually come from China. And you would assume a lot of these vehicles are shipped through the Pacific Ocean, avoiding the Red Sea. But we'll give them benefit of the doubt that it had some impact. Maybe it's not necessarily the shipment of vehicles, maybe the shipment of parts, right, through the Red Sea that's impacted the production in China. And remember, they actually cut some production in China recently as well. So that could be the reason. But like you said, Rivian sales have gone up. Is there anything specific to Tesla? I don't really think so. One quarter is not going to tell us the trend for the long term. I think Tesla vehicles are still, liked by a lot of consumers. We just did a survey actually recently, a buying intention survey. Tesla has the greatest brand loyalty still amongst all brands in the auto industry. Yes. So, Steve, I guess obviously the big question on investors' minds is, what is the real demand for EVs in general, and Tesla in particular, look in the near and intermediate term? Do you have a view on that? Yeah, I've always thought that not only Tesla, but the entire EV market is going through a rough patch this year and likely into the next year. My long-term view is still optimistic about EVs. I think there's enough policies out there to push, greener vehicles, more greener vehicles on the road. I think the issue today is about affordability. There's actually not enough affordable EVs out there for the masses. Currently, a lot of vehicles are expensive. They're over $50,000, and not a lot of people can buy them, especially during high interest rate environments.
So that has been the rhetoric really for a bit. And Elon Musk seems to say, okay, we're going to do the lower cost, but give us a second, right? We had this wave of Model Y, Model 3, et cetera, and now we're going to have another wave of more affordable EVs. When does that wave happen?
A lot of it actually comes online at the end of 2025, starts coming online at the end of 2025. That's when you have the Model 2. GM is also relaunching the more affordable Bolt. All of them are, $30,000 or less. And then you have, GM will continue to roll out cheaper vehicles. And you have Rivian also launching the R2 and R3, in 2026 and 2027. So
who doesn't want a car named R2, by the way? Yeah. Total side note. Everyone. But go ahead.
Yeah, but a lot of more affordable EVs coming in, and the hope is that the addressable market for the EV market, for the EV industry expands, as more cars, cheaper cars come on the road and are available to consumers.
But if I were an investor in this company, I'd be saying, okay, you need to bring in a cheaper priced car for the mass market, but I'm not sure you can convince me that you can do it at a profit. What's the expectation of their ability to churn out lower price models on a per unit profitable basis?
That's a very good question. I think scale is the most important thing. I mean, this is a scale volume game in the auto industry, has been like that for 100 years. So, the question is, are the cheaper vehicles going to resonate? As you push more production through an assembly plant in the auto industry, the unit cost does fall significantly in a logarithmic kind of trend. So we're hoping that it'll cut. But specifically to Tesla, I want to also mention that they've done a really good job in vertically integrating their processes throughout the whole value chain, right? And that actually does cut costs, especially in newer tech like this. If I look at over 100 years ago, Henry Ford basically did the same thing. Switching everybody from horse carriages to automobiles actually required Ford to vertically integrate and able to manage costs and manage design and be nimble and flexible to react to consumer tastes.
In the meantime, before we let you go, just that stock has been so painful. Like 160.29 is sort of the low that we saw back in April, and then after that, you got to go all the way back to nearly $100. Do we get there? What do you think?
I mean, I don't think it'll get there. I think there's still a lot of value in the company. They've basically changed the paradigm, shifted the whole entire auto industry in terms of vehicle design, in terms of manufacturing. But don't forget, right? They also is doing a lot around full self-driving, autonomous vehicles. They have a supercomputer that's actually doing that for them. So there's still a lot of hope. I think if you talk to the bulls in the street, there's still a lot of hope in them rolling out the FSD, the full self-driving, full to everybody on the road and get to level 4 and 5 autonomous driving.
All right, Steve, thanks so much for joining us. Steve Mann, Global Autos and Industrials Research Analyst, Bloomberg Intelligence, coming to us from Princeton, New Jersey via the Skype thing. Again, Tesla down, down 6% today on that pretty big. Actually, most of the analysts are saying an extraordinarily big miss there. Really a surprise to the marketplace. Stock down 6% today, 34% year to date. And again, as you mentioned, Alix, the company in the press release calling out a lot of supply issues as reasons for the miss, not calling out a demand issue. But of course, that's what a lot of folks are concerned about as they think about not just Tesla, but just kind of the EV market in general. So trying to think about the ultimate demand for electric vehicles in this market.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's add one more name to the downside here. It's Apple, down 0.6%, although it could be worse, like it could be Tesla, so there is that. But I take a look at this chart, Paul. It is ugly. We surpassed the low that we saw earlier in the year, in early March, I should say. The next level, if I just look at it, looks to be what we saw at the low back in October of 170. I mean, it looks really, really ugly. And you have to wonder where we go from here.
Yeah, Jess Menton, our good friend from Bloomberg News, covers the stock market. She's got a great story out today, and just kind of putting it into context. The first quarter, the stock was off 12%. That's the worst performance relative to the S&P 500 in over a decade, just to put it in perspective. I
mean, usually if you see that kind of downdraft in Apple, you're like, oh, forget it.
Jump.
NASDAQ 100 is rolling over. Everything's going to be terrible, and that hasn't been the case. Anurag Rana joins us now, Bloomberg Intelligence technology analyst, standing by. So do we breach the 165 low that we saw back in October of 2023? Do we have to go back to earlier next year? Like, where's the bottom, Anurag?
Yeah, it's very tough to say. The only reason is because when you look at Apple, the fundamentals are not good right now because of a lot of pressure in China. And we see no hope at this point that's going to change in the upcoming earnings season. I think the only silver lining for Apple could be if during the June Worldwide Developer Conference, they are able to announce any big, AI push into the phones. That's the only thing that can perhaps, go out and give you a new refresh cycle by the end of the year. But other than that, it looks like a pretty bleak year for them on a fundamental basis.
How about from a technical basis? I would think that these guys are buying back stock aggressively. They can even be more aggressive if they wanted to. Does that put kind of a floor for this stock somewhere in or around here, do you think?
Yeah, I've been surprised that they have not been more aggressive in buying back shares over the last few years, because they do have the capacity to do it. They spent somewhere around $90 to $100 billion, almost their entire free cash flow buying back shares. But they've talked about being a little more aggressive in principle, but in practice, I've not seen that. And, perhaps maybe this year could be a change while they go out and do some more, but I haven't seen that yet.
So what do they do? If that's the case, that's it. What do they do?
So one of the things you'll see is by the fourth quarter this year or by December, you will see easier comparisons in China. So that could be, one hope. Second thing is we are seeing a big push from Huawei right now because of the brand new phone that they launched last year. That's really driving a lot of the sales. And that's going to go out an anniversary a year from now. So, you will see, you could say, a lower benchmark or a lower, waterline for them to cross for next year. And with some Gen AI features coming in this year, one could expect that maybe next year we could see that, instead of the 0 to 5% growth, maybe we can see 5 to 10% growth on the top line. And I think that can change things around for Apple.
So is there a bear case that China doesn't turn around? China is no longer a growth market for Apple, be it competitive issues, be it change in investor sentiment towards Western companies and Western technology, be it the economy. They could be in for a Japan-like period of malaise. You could really paint a reasonable scenario where China's not a growth market for them, ever.
Yeah, and then they have to sit down and look at their strategy and say, do we really go down the chain of, cutting down pricing? They have never done that. They've always believed in margins. But if they were to, push a lower priced phone, let's say in the emerging markets, whether that's in India, Indonesia, Brazil, that can really help out and take care of some of that offset in China. But we haven't seen that. Apple doesn't play that game. Yep. It doesn't, we go down that market. But they can actually do that if need be, in order to gain market share, but we haven't seen that yet.
So you have CCTV over in China reporting that President Xi and President Biden talked last night discussing China-U.S. ties, etc. Do you feel like Tim Cook is calling government officials, being like, you guys got to help me out here?
Yeah, see, if you see in the last 1 month, he went to China and he basically promised them that he's going to do more investments in the area. And that is on the back of a lot of discussion about supply chain diversification away from China. So he's made a couple of trips in the last 1 year, basically saying that, listen, we are here for the long run. Please help us out. Maybe we need 2 or 3 or more of these phone calls, and China is going to be back up for them.
If I were buying Apple computer today, I would have one catalyst, and that would be AI. There's no AI in the Apple story, and I'm buying the stock today because I think Cupertino will figure out a way to get AI into the narrative. Would that be a decent call there?
Oh, that would be a very decent call. In fact, the news released by Mark Gurman that they're talking to Google about Google's large language model, I think that's going to really help them if they go out and make that partnership, because Google is the search engine king at this point, and they are the default engine for Apple products. So they have an old relationship. Google pays a lot of money for that search rights on the Apple ecosystem. If Apple's able to go out and showcase that you need to upgrade the phones because you need a better memory and you need more processing power, that is a case for people to go out and, people with older phones of iPhone 11, 12, there are a lot of phones out there that are really old at this point, and, which you need that processing power, you may lead into a refresh cycle out there.
Anurag, what do you feel like, at some point though, does Apple need to do their own AI strategy? they don't tend to do that partnership stuff, right? They kind of cleaned a lot of their ranks with the car, self-driving car, putting that aside. They were supposed to repurpose those people into AI, and then that didn't happen. I mean, at what point does that become an actual good catalyst for the stock?
So they are pushing a lot of money into that area. But remember, Google's been doing it longer than them, and they are still trying to figure out some of their applications on, similar to ChatGPT. Now, I think, you just can't expect them to, they just shut the car division down a couple of months ago, and, they just moved the engineers. You can't expect them to come out with a product in the next 3 to 6 months. It's going to take some time. Meanwhile, there is nothing wrong in licensing technology from Google. Remember, Apple's not in the search business. They license that technology from somebody. It's possible for the short term, they will license that technology. And after that, once they figure out that things can work on their ecosystem a little bit better as part of their operating system, they don't need that partnership. But, I think in the near term, they do need to, partner with somebody, either Google or OpenAI.
So for this developer conference in June, how big is that going to be for the company and for the stock?
I think it is probably the biggest, moment for them for the last couple of years, as we have seen a reduction or a decline in the growth rate of their products business, which is predominantly, iPhone and all the others. I think this is going to be the biggest catalyst everybody's watching for and see what can they showcase. If they are able to convince the street that this is going to lead to the next big push in people going up, and not just, products, it's going to help out services also. It's going to make some of those products a little more stickier. People, make fun of Siri, for example, right now. If it's powered by Google, if it has a lot more, firepower to do a lot of operations, maybe I'm not going to open the third-party app that's on my, phone to go out and search for things that I'm doing right now. Maybe I'll just be by default using it. I say this a lot. I mean, Google and Apple, for that matter, control the distribution of the operating system through the mobile apps. That's a very powerful ecosystem. I'll request you guys to look at what was TripAdvisor a few years ago, or what was even Yelp. I mean, those market caps have really gone down because people go to Google directly and search for those things rather than going to the applications. So I think if Apple's able to play this thing out properly, their distribution system is strong enough to, really monetize on that.
It's true. I don't trust Yelp anymore. I don't know what that's about. But
okay.
but then on the flip side, then you have all the regulators, right, from the EU and the US, fines. They want to rethink how they're doing things, how they wind up putting. So there's also that hidden risk up there. Anurag, I've got to let you go, but great stuff. Super appreciate it. Anurag Rana joining us from Bloomberg Intelligence. They're clearly coming after their ecosystem.
Oh, yeah.
And by they, I mean European regulators and US regulators. So how do you get ahead of that, and how do you manage it when that's going to be your lifeblood at the end of the day when you run out of cool products?
Right, and that's going to be something that's one of the many challenges, many headwinds that a lot of folks, when they look at Apple, they say this is something that this stock has to deal with. It's a headwind, just like it was for Microsoft for the 80s and 90s until they were able to put that behind them, write a few big checks along the way.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
The S&P drawdown so far this year has only been barely 2%. So do we get there? Let's ask Shelby McFaddin, investment analyst over at Motley Fool Asset Management. She joins us now in the Bloomberg Interactive Brokers studio. Shelby, is this the sell-off we've all been waiting for? Is it a buy the dip kind of thing? What do you think?
Unfortunately, I'm going to err towards no. And I'm really heavy on that, unfortunately, right? Because we know these valuations have just been so rich. And when you're looking at the long term, for your investment strategy, it's easier to say, okay, we'll just sort of hold out, it's all right. But we do get really excited about some of those buying opportunities, either to add to current positions or to be able to enter new ones. So I think when we look at what might cause a dip, we don't yet have those factors being quite as strong. I think we might need a couple more quarters to see at least what might happen with interest rates being a sort of force to push the market down a bit more.
So do you need to see higher rates? Do you need to see weaker earnings? What do you think what do you think will push this market down when and if we do get that correction?
I think it could be a combination of both, and it really, in some ways, depends on the sectors, right? So when we think about tech, we do know that those being, higher duration, very sensitive, that interest rates are going to most likely affect the tech sector quite a bit. And then on the other end of that, small caps as well. We've seen the sort of damage that can be done to valuations to both of those groups. So that's one sort of focus. And then outside of that, we do, again, need to see the change in those fundamentals. So in some of the companies, we're seeing that the valuations are just stretched for optimism, for wanting to hold on.
At the same time, though, if interest rates are going up, and I say interest rates like the 10 years going up because the economy just firing on all cylinders, does that change the reaction function to, say, small caps or big tech?
In some ways, yes and no. So if the economy keeps firing, we might sort of have a situation where trading sort of shakes out those who are not interested in holding out and seeing whether there is more or less volatility than they've expected when it comes to things like small caps, especially due to that thinner trading volume. But when it comes to the larger caps, there's a chance that we kind of just settle out at a higher clip, that we end up with what is the Fed's fear, is that we just step up in inflation and in valuation basis. So it's one of those things where, unfortunately, it's a little bit of a seesaw, and we all have to sort of wait for it to shake out.
One of the names on your list is CRH. It's a Irish company, which is why I'm interested in it. Building products company. Talk to it. Is this an Infrastructure Act kind of play for you guys, CRH?
Yes,
which is
so
the ticker.
When we entered the position, that was one of the reasons that we had piqued some interest. Another was that they were going to be moving their listing from LSE to the New York Stock Exchange, and going ahead and starting to do their gap reporting. So realizing getting a little bit more bang for their buck, starting to get that multiple that they were looking for. And of course, the fact that the IIJA was going to bring forward some of that cash flow for them. On top of that, before the infrastructure build, they were already the #1 provider in North America for asphalt, ready-mix concrete, cement. So they were sort of this sleeper agent in all of the repair and just keeping up with the roads and things like that, apart from any new build. So it's a company that is not thought of a lot, but they're really king in what they do.
How is the booking for that all working? Because I've been struck with, say, the infrastructure bill, for example. Like, we all were expecting like a huge wave of money and orders, and like the orders are there, but like it's not coming the way we were all expecting in the middle of like a structural shift. The industry is still cyclical.
And you're absolutely right. And what we've seen and what management has mentioned is that they're getting stretched out a bit. So the contract money is coming through, but it's not coming through, 24, 25. It's 24, 25, 26, 27. And they're not necessarily being canceled, but they're being taken in slimmer chunks. And they have to get finished, but at the end of the day, rates are still high. And so construction can still be a bit more expensive, especially when you're talking about new as opposed to repair and remodel. So yeah, that contract stretching is absolutely a real phenomenon there.
So you've got a real estate company on your list of stocks. You guys are looking at it, and that's got to be a dicey place to be. Alexander Research Real Estate, ARE is the ticker symbol. Talk to us about that company, because I'm nervous about anything that's got real estate in its name.
And I think that's completely fair, and I think that a lot of folks would think that on first hearing as well. What we're really interested in with Alexandria Real Estate is, one, the valuation. They've gotten crushed because why? Real estate.
Yep.
But what sets them apart is not only their really deep bench on management that we like, they've got an outstanding return for investors when it comes to cash delivered back. They really just pump out cash as a REIT there. And also their focus on healthcare and life sciences. That's really what we're hinging on when it comes to our thesis for Alexandria Real Estate. And because of that, they're also just less exposed to that office that is really crushing a lot of the REITs right now, because they're not having to deal with that pendulum swing of overdevelopment of offices, making them that sort of second home for employees, and then employees sort of saying, I'd like to never come back, thank you very much. So when we have these new advances in sciences, they need more buildings. And that's really the crux of the thesis for Alexandria Real Estate there. So if they can keep delivering on cash and keep on that train, it's a great investment for us.
So you guys obviously have done the work on the real estate space. You're based down in the DC area, right?
Yes.
Are federal employees, are they back to work 5 days a week, 4 days a week, 3 days a week?
I knew you were going to go here. 100% knew that.
What is that?
It seems to be a bit agency by agency at this point. From my understanding, friends of mine that I know are more about 3 days. When you're looking at the contractors, many of them are fully remote now. So it kind of depends. If you work for a 3-letter, you're probably in 4 or 5 days a week. If you work for a different agency, you might be more flexible.
I do notice a difference, though. Like, not being in the office, you 100% miss out on those like random conversations that all of a sudden like mean something in a few years
But I
or
think
even
that
6
ship
months.
has sailed, though. I think that ship
I think
has
you're right.
sailed.
I just don't know like what the career
So
path.
but if I were
would be.
investing in real estate,
Yeah.
that would be my base case. Like
Yeah.
occupancies, whatever they are today, that's what I'm going to model out.
Yeah.
They're not going to get any better. I don't think they're getting any worse. That's what I would model out.
And the same idea at Bloomberg is like you have a desk, right? But if you could also go to any desk and it would be the same experience, like
Absolutely.
that kind of idea versus sort of here's an office kind of thing. You also like Meta. That stock is up a whopping 130% in the last year. You still like it at these levels to buy?
Yeah, so at this point, it is a little bit rich in the valuation. So we do watch out for any sort of opportunities. And the thing about these tech stocks is that because they can be a little bit volatile, you just watch every day and sometimes you do get one. But what we like about it is that their say-do ratio, as we call it on our team, has been
Say-do?
high.
What's
yes,
that?
the say-do ratio. So they say they're going to moderate costs. They say they're going to go ahead and sort of leave behind any investments or capital allocation that's not paying off for them. And over the last 18 months or so, they've done it. We've seen that improvement in their margin. We've seen it starting to come through on cash flow. We see that management's getting more serious about tangible ways to handle AI. And also when we look a little bit forward, we compare them to another advertising competitor. Meta's got more retail media exposure, which in these times, consumers turning a little bit more to goods as opposed to services. So when we look at the advertising market in search, for example, that's going to lean a little bit towards services. As goods are coming down more, retail media has an opportunity to stand out. So Meta is definitely a little bit more poised in that regard.
Yeah, that went from being, since its inception, a top-line revenue growth story to really over the past 2 years to being a cost-cutting story.
Yes.
And that's what worked. I mean, I didn't see that coming, but they actually did.
They did it.
What they said.
Yes.
See, the
Say-do.
rate.
Say-do.
I learned something. That's so cool. What other company has a good say-do?
Ooh, who else has got a good say-do? That's a great question.
Who has a bad one?
Well, I don't know if legal wants me to do that, but
Oh, that's fair. Fair enough.
But I would say we could probably throw Apple out there for having a decent say-do. And in some situations, I think what ends up happening is their valuation gets sort of bounced around like a hacky sack because they say that they're going to do very reasonable things, and sometimes that's not enough for the market.
Right.
Fair enough.
Mature companies tend to say that, and when you want that intense growth, and they say, well, we're actually not there. We're kind of giving cash back and we're doing responsible allocation. They're saying it and they're doing it, but it may not be what the market wants to hear.
Yeah, the market wants to hear, don't worry about China.
Yeah.
China's fine. Don't worry
Yes,
about China.
exactly.
We're selling lots of stuff there, and don't worry about it.
Great stuff. You're awesome. You come back all
Thanks.
the time. Shelby McFaddin, investment analyst at Motley Fool Asset Management. I think we should do say-do ratios
Yeah.
like all the time.
Like Tucker, does he rate well in the say-do ratio?
I think he totally does.
Okay. All right.
Like he delivers. Like what you
you for
what you
defending
see is what you get. You
yeah,
know.
that's true. I know what you see is what you get. So
I don't know. That somehow sounded like an insult, but it didn't. I didn't mean it to be one.
exactly.
I'm gonna take this and run with it for a very long time. Okay, Shelby, thanks a lot. Really appreciate it. Loved having you join us there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, let's get to the bond market here because you're looking at back-end yields continuing to rise. It's after a pretty solid sell-off yesterday as well. The 10-year yield up by about 7 or 8 basis points. We're looking at the 30, the 10. They're all at the highest level now that we've seen so far this year as stocks wind up dropping. Ira Jersey, Bloomberg Intelligence, chief U.S. interest rate strategist, joins us now. Ira, how do you square the data that we continue to see, ISM manufacturing, the JOLTS numbers, even factory orders? Like, how much higher can we go in yields before things start to hurt?
Yeah, well, obviously they're going to start to hurt risk assets probably sooner rather than later, just because the expectation has been that the Fed was going to cut interest rates. And as we keep on getting these better and better numbers, we're just going to either do one of two things. Either we're going to price out rate cuts altogether, or as you've seen recently, is we're just going to push out when those cuts are going to start because the economy is just not slowing. So you know, the higher yields that you're seeing, I think, in the back end of the curve is just a reflection of the idea that if the Fed does ultimately cut, it might not cut that much, number one, and number two, that the cuts are going to continue to be priced out. What's surprising me about this move is that a lot of it's coming in the back end of the curve. So like you mentioned, 10-year yields, 30-year yields. 2-year yields have gone up and are at around 4.7%. They're still pricing more or less for 3 interest rate cuts this year. I think that that's probably the next nut to crack, where you really need those 2-year yields to go up toward 5% in order to get 10-year yields above 4.5 for sure.
Is there a scenario, Ira, in any of your crazy models that you and your team have there down in Princeton that says no rate cuts in 2024?
Good one.
Yeah. So there actually is, and I think that that's a case that you can't completely dismiss, especially when you see the strength in the data as powerful as it has been recently. Unless you wind up getting a more significant slowdown in inflation amid this very strong growth, which seems less and less likely as time goes on, then the possibility that the Fed doesn't cut interest rates at all this year and maybe into next year has to be on your radar. And I think and one of the things that you've seen in the rates market, LIBOR is no more, so now we use something called SOFR, the secured overnight financing rate. Well, so most short-term interest rate bets are put on in SOFR futures right now. And if you look at the options on those futures, there's now about a 20% chance being priced that the Fed does nothing or even maybe hikes interest rates before the end of the year. And I think that that's a significant shift from where we were in mid-February when we were pricing only for cuts. It was a matter of how many.
That's interesting. Yep. So does the fact that we're seeing more move in the back end versus the back end versus the front end, what does that tell you about the potential hike or no cut scenario?
Well, I think a big part of it is people were, I think, edging long. So, a lot of people, including our own Bloomberg economics team, thought that we were going to start to see a significant slowing in the economy now. So they had gotten long interest rates, had gotten long treasuries, and were ready for a rally. So I think one of the reasons you're seeing the back end underperform a little bit is just people getting out of that risk. Once those positions are cleaner, then you wind up with a scenario where people look at the fundamentals and say, okay, what's the actual fair value for 10-year yield and 2-year yield? Right now, everyone's kind of in risk management mode, saying, okay, we're too long risk given the economic environment. Let's right-size our risk, and then we'll determine whether or not there's some value here or value or not value there. So I think that's the mode that we're in right now. Plus, remember, we're early in the quarter. I think some of the positioning last week had to do with month-end rebalancing before people put out their quarterly or semi-annual fund reports and the like. So some of this maybe is that people wanted to be long going into quarter end, and now they don't see a big reason to be long at the moment. So that's one reason why people are getting out of risk. And it's easy to do when you see decent data like we've had the last 2 days.
So the 10-year, Ira, I've got it at 4.38 here. Is there a technical kind of level that I need to be watching for? Like if it breaks above 450, then it can go significantly higher than that. Is there any technicals here that you're paying attention to?
Yes, and we just broke a very important one, actually. So 4.35% was the level that we were watching the last 2 months. Now that we're above that, we'll be targeting 4.51%, call it 4.5% for round numbers. And then above that is 4.7%. So we really have a little bit of a gap here, another 10 or 12 basis points. Interestingly, when you look at some of the momentum oscillators, I was just looking at this with Chris Kane, one of my other Bloomberg Intelligence colleagues, who's a chartered market technician. So he's one of those people with a 3-letter acronym after his name and looks at charts all the time. So he and I were actually just talking about this, and the relative strength index and some momentum oscillators aren't yet at extreme levels to think that the sell-off is over near term. Now, you get another day like we have today, then those momentum indicators will be in extreme levels, and you can maybe think of a little bit of a pause in the sell-off for a little while. But we're not there quite yet, so we could see more volatility. When we have some Fed speakers at 12 today, if they sound a little bit more hawkish than Jay Powell was last week, then certainly you can wind up probably adding on to some of the market angst right now.
Some feels like an understatement. We got Bowman speaking at 10:10. You got Williams speaking at 12. Messer speaking at 12:05, and Daly speaking at 1:30.
Why did they do that? Did they get paid to speak?
I don't know.
What is
That's
this?
a good question. Why? Yeah. Well, so what are we going to learn from like a million different Fed officials at the same time?
Well, so a lot of the Fed speakers, these lunches and these different activities that the Fed presidents, the regional Fed presidents or Fed governors do, a lot of them are scheduled months and months in advance. They're part of their job is to be out in the community, listen to people, let the public know what their thinking is, how they think the economy is going to be, what monetary policy is going to be. It's part of their job. It's funny. People always ask me, why do these people go out there all the time and make all these comments? They've actually always made these comments. It's just when Alan Greenspan was the chair, we didn't pay attention to anyone except Alan Greenspan. and more recently, things have been more democratized within the Federal Reserve. So therefore, all of these Fed speakers get more attention, maybe than they deserve. But it is helpful in the fact that now we know what the distribution of the Federal Reserve looks like in terms of, who thinks that interest rates should be raised, who thinks that they shouldn't be raised, who thinks they should be cut, right? So there's a variety of views, and having those views, I think, does muddy the waters a little bit. But in aggregate, though, these discussions have always happened. Just it was, we just didn't pay attention, and now that we do, we wind up having more headlines and maybe generates more volatility. The Fed maybe could pull that in a little bit and basically say, hey, don't make a lot of monetary policy comments. But I think the cat's out of the bag now, and we're just going to have continued Fed speak that's going to be very important to markets on a minute-to-minute basis.
All right, Ira, I'm all in on the men's and women's Final Four, so I'm not really paying attention to soccer. But if there's one match I need to follow in your world of soccer, what would it be?
Oh, I think Aston Villa, of course. My Villains have had a big win over the weekend, a 2-0 victory, so we're moving up the table. I'm going to watch the Villa match this weekend for sure.
All right, Ira Jersey, good stuff. We appreciate it as always. Ira Jersey, Chief U.S. Interest Rate Strategist, Chief Soccer Strategist for Bloomberg Intelligence, bringing it to us from Princeton, New Jersey. So I don't know, I'm all in on the Final Four. The women's had great games.
You're looking at me for sports, dude. What are you doing?
Women's sports. I'm just saying I'm all in. And this is the first year I've really been paying this level of attention. I mean, Michael Bard, the business of sports, he's always in on it. But that's, I'm kind of paying attention to it. So
Final Four, yay. Women,
yay. There you go.
That was better than an NBA game, I would say, last night.
It was. I mean, it's just super competitive, and that's all you want. And they got a great Final Four: UConn, South Carolina.
What's
North
the
Carolina
pay scale now? Male and female athletes.
Non-comparable. It's just not comparable.
It's not even there.
No.
Do you think that changes now after?
No. But it gets better. I mean, the women are getting more and more and more, but so are the men, and so it's just getting kind of crazy out there. So we'll see. But anyway, got the Final Four to look forward to this weekend. That's coming up.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
How about this for an investment strategy? Maintain very low exposure to overall stock markets by being long selected high-quality companies and short market indexes. That's what our next guest is up to. Lukasz Tomicki joins us here, founder and managing partner of LRT Capital Management, joining us from Austin, Texas. It's got to be overcrowded by now, Austin, Texas. Everybody I know is moving to Austin, Texas.
Agreed.
So anyway, he's down there. Lukasz, thanks so much for joining us here. Talk to us about your investment strategy. Did I characterize that right? And how has it performed for you?
Yeah, no, it's I think exactly right what you said. We don't predict what the market is going to do in the short term because I don't think that's something we have any expertise in doing, and frankly, we don't think others can do that. But our strategies have, to put it politely, crushed the market with very low volatility and very low market exposure. So it's worked out fairly well.
What do you do when you wind up seeing, though, like record after record for the overall S&P? I mean, I appreciate today is a little different because we're actually down 1%. So how do you kind of fight against that?
Yeah, so, our strategy, because we're effectively buying quality companies and then we're shorting indexes, which in a simplistic way, the index is quality plus junk. Junk typically outperforms in a type of FOMO market that I think we've had over the last 3-4 months. So it is a little frustrating on a day-to-day basis because you can see, why am I doing all this work when I could just buy Truth Social and make all the money, or Super Microcomputer? But I think over the longer term, when you have a downturn and they do happen, corrections as we call them, you do see the value of being disciplined and having an actual strategy.
So how do you define high quality companies in the long side of your portfolio?
Sure. So for us, when we're talking about quality, it's really down to a combination of qualitative and quantitative metrics. So we're looking for, number one, companies that have some kind of moat, meaning some kind of ability to earn high rates of return on invested capital, and more importantly, sustain those returns over long periods of time. And here, these are simple things that Buffett has talked about for 50 years. May it be network effects, scale economies, intangible assets, brands, patents, licenses, government approvals. And then that's number one. We're looking for something that can earn a good rate of return. But number two, it has to be able to actually reinvest within that competitive moat. Because if you're just generating cash, generating returns, but you can't reinvest, you're just returning that to shareholders, the moat is kind of in the present and in the past, but not necessarily in the future. And number three, we're looking for management teams that do a reasonably good job of capital allocation. Because ultimately, capital allocation is that link between shareholder value and business value. And so if you have a bad management that allocates capital poorly, then you may have a good business, but you may actually never see the benefit as a shareholder come through. And so every business is different. No business is an A+ in all those three dimensions. And so it depends on the business which one you weigh more. If you think about a Visa, you have an incredible moat. You have a business that grows generally faster than GDP every year. And there, the management doesn't matter that much. I mean, as long as they're not actively setting the company on fire, I'm sorry, but I could become CEO of Visa tomorrow and I would kick my legs up and probably do nothing for the next 5 years. And very little would change in the trajectory of Visa, the business, right? And then you have other companies like a Danaher or a TransDigm, which are growing through acquisition. So their management, acquisition, and capital allocation strategies matter tremendously.
To that point then, are there sectors that could sort of fit the bill, or is that too hard to dissect? Because it's truly on like a company by company and management basis.
So, there are some sectors where you find companies with more moats than others. So technology, business services tend to lend themselves to high switching costs, intellectual property, network effects, etc. On the flip side, we're not very interested in commoditized businesses. So you're not going to find a lot of mining in our portfolio. You're not going to find a lot of shipping names, commoditized airlines, those sort of things. We do look for things that have commodity-like exposures where we think there actually is a moat, but the company may trade in a way with a commoditized sector. And because that's very important for a diversification purpose for the portfolio.
Lukasz, how many names do you typically have in the long side of your portfolio?
So as of today, we have 94 positions, and we typically are around 80 to 100. But the top 20 names are about 45% of our long exposure. So that should give you a sense of how that balances out. And typically, the larger exposures in our portfolio are the lower volatility names. And so the names like a trade desk, for example, which we own, which is a business that we admire and we think has a durable competitive advantage, but can be very volatile. It's not uncommon to see trade desk up or down 10 or 20%. That's a sub 1% position for us. Whereas something like a Chemed, which is a very stable, very kind of boring business, that's around a 3% position. So we size really based on the volatility contribution of the different pieces in the portfolio.
But before I let you go, do you have AI plays?
We own TSMC, and we think that's probably the best picks and shovels name that we can come up with. There's plenty of AI names and semiconductor companies that are within our portfolio or that are within our, call it, investable universe. But we don't have sort of the hottest ones that everyone has, be it NVIDIA and others. So TSMC is really the largest direct exposure for us in that space.
And on the short side, you just short SPX, or how do you play the short side?
So we're shorting mid and small cap indexes, and that's to just match the basis risk of the long side. So typically most of our companies, we do have things across the market cap spectrum. So TSMC is obviously a giant company. We own Northrop Grumman as well. But actually most of our names are mid caps. So as a result, we're primarily short mid and then some small cap indexes. And we're short 5 particular indexes. Nothing too fancy, things that you would know.
Right. All right, Lukasz, fascinating strategy. Put up some good numbers. So good for you guys. Lukasz Tomicki joins us here. He's a founder and managing partner, LRT Capital Management, joining us from Austin, Texas.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.